module, we'll be covering Chapter 6 and talking about rental housing activities. We'll be covering both the development of those projects, but also then talking about the long-term affordability period and the home and ADFA restrictions and requirements that go along with that. So here's our chart that we've seen a number of times before, just reminding you that there are program-wide rules that we've already discussed that are going to apply to a rental project, but there also are rules that are specific to rental projects. And then when we're talking about the development of rental projects, we also have some development-related rules that we'll be talking about. So who's eligible to apply for rental funding? So ADFA recipients would fall into essentially two categories, either entities that are going to administer a program, so they would be dispersing funds to others, and that would be either a unit of local government or another public agency or nonprofit. A lot of our rental funding will go directly to owner, developers, or sponsors for specific projects. In the case where the funding is for the development of rental housing, then generally that recipient will be the entity that is actually directly responsible for the development of those funded units. This is another activity that a community housing development organization, a CHODO, when they are developing a project within their service area and acting as owner, developer, or sponsor, can be certified to be able to utilize the CHODO set-aside funding. As you recall, there's a minimum of 15% of the home funds that ADFA receives are required to be funded in conjunction with a CHODO certified project. So there are a number of approaches that we might be utilizing for rental housing. And much of that's going to depend on your local market. So if there are an adequate number of units and they're in meet our property standards condition, but they're simply not affordable, we might be investing funding in acquisition to purchase units and then as part of that, provide affordable rents. In many cases, the units that are available in markets need a reinvestment of funding, and so it might be a rehabilitation project. In many instances, we're going to see that combined with acquisition. And then in many markets, we simply need some newly constructed, decent, affordable, energy efficient units to be added to that local affordable housing market. And so we'll see a lot of new construction done utilizing our home funds. So in the case of acquisition, the way this essentially works to create affordable housing, the home funds are used to subsidize the cost of the purchase of that property, and in return then, the agreement would be that there are going to be units within that project. They're going to be restricted to be rented only to income-eligible persons. They're going to be capped with our home rents, so we make sure that they're going to be affordable rents. And so there'll be a number of rules that would apply to all of those home units. So the occupancy would be restricted to income-eligible individuals. We're going to have caps on the rent and utilities that tenant would be responsible, standards throughout the affordability period on how the unit quality is maintained. And then we'll talk a little later, there are some lease provisions that are prohibited in a lease for a home funded project. So for example, if I had a 6-unit property that the purchase price was $1 million, to be able to cover the mortgage on that, cover my taxes and insurance and ongoing maintenance expenses, I would have to charge a particular rent to be able to make that project viable. By investing home funds in that project, I essentially cover part of those costs. And so that allows the project to be able to afford to charge lower rents because some of that debt has been covered with the home investment on that project. So in the case of rehabilitation, this allows us to take existing structures and alter, improve them. We're going to have a long-term affordability period and not have the ability to put in additional home funds during that affordability period. So it becomes really important as part of that rehabilitation to bring those units up to standards, make sure that they are going to be maintainable and sustainable throughout that affordability period with just modest reinvestments that are coming from the cash flow from that project. So a couple things to keep in mind. It is eligible under rehabilitation to add on rooms. So, but we can't change the number of units within that project or it becomes new construction. So for instance, if I had an existing project that had maybe 1-bedroom units, it might be that I could add on some space to each one or some of those units to modify some of those units into being 2-bedroom units, which would better meet the local housing needs. That would be acceptable under rehabilitation. What I could not do, let's say this project had 10 units, I could not add to that structure or add on to that site and build 4 more units on that property. If that was done as part of that project, the project would be considered new construction. Why is that such a key point? Well, when we get to talking about our affordability periods, our rehabilitation is based, the affordability period is based on our average investment per unit, and it's 5, 10, or 15 years. If a rental project is new construction, it would have an automatic 20-year affordability period. So it makes a difference on how this project is set up within the home program and what then the applicable affordability period would be for that. We see projects with a wide range of rehabilitation that's done. It's going to be based on the needs of that structure. And of course, we want to go ahead and do not just what's broken on those units, but bring them up to a good standard so they're going to be sustainable. So we won't have a lot of expenses during that affordability period that we're perhaps going to struggle to be able to cover. Oftentimes, this is going to be combined with acquisition of the property. And keep in mind, and we'll talk later, there are property standards that are going to apply for the overall project. And then, of course, for all of our home-assisted units, that will have to be documented. For new construction, a lot of our home funds are used for new construction, and many times they are paired together with other funding sources. So home funds could be used for at one particular time within the development process, such as construction loan funding. It might be for a specific aspect of that. So we might be using our home funds to acquire the land, and then other funds are going to be used for the construction. But overall, when we put home funds into that project in any aspect of it, it becomes a home project. So it will require all the home underwriting eligibility requirements. ADFA is going to be completing a cost allocation process to determine the minimum number of home units that would need to be designated in that project, and it does trigger the long-term affordability requirements. So the examples that we're given here is we might have the land being purchased by the home funds and the low-income housing tax credits being used to fund the construction. Home also makes it possible to be able to do mixed units where we have some of the units be market rate, some of the units being home designated. And so ADFA is completing, based on HUD guidance, what they call a cost allocation process, where they would be determining, based on the proposed investment and the maximum subsidy limits, determining how many home units would be required based on the investment in that property, essentially making sure that the home funds get a fair return on their investment with those number of long-term affordable units. So this allows the project to be able to designate some units as home units and trigger the long-term affordability requirements, and other units not to have those restrictions, and so be perhaps market rate. In many of our projects, we'll have a mix of funds, and so we may have some tax credit units, some tax credit and home units combined together, and we might have some market rate units within that same project. Your written agreement will detail that so you're very clear on what units follow what restrictions for that project. So when we define a rental project, HUD's provided some very clear guidance on this, and we essentially have 3 criteria on this. So to be considered a rental project, we're going to look at all of the buildings, all of the units that are under common ownership, common management, and also financing, so within one financial package. So let me give you an example. It might have a developer has maybe a 30-acre site. They might come to ADFA and request funding for a phase of that development. So they might build out the first, I don't know, maybe 80 units as part of that project. They might, at a later point, come back through, ask for funding for phase 2. Once phase 1 has been completed, is fully rented, they might recognize that the market was ready to absorb more units and come back for a second phase. While both phases of that project would have common ownership and common management, they were financed separately. So that proposal for financing was based on each of those phases, not for the overall project. And that's how we're going to define what, when we're talking about a rental project, what all is included in that. So it's not just the home units, it's the development that was proposed as part of that financing. If it's a single project, then all of the contracts that would include all the activities that are happening on that site. And the project would include all aspects of that project. So sometimes we have folks say, well, I'm using some other source of money, so even though it's part of this project, I don't think that I need to follow some of the federal rules that go along with this project. If it's part of that overall project, then the same rules are going to apply whether home funds were utilized as part of that or some other source of funding. That's why it's important to understand how we're going to define what's included in that rental project. So eligible projects, well, there's no specific requirement for the kind of structure or the style of property. That's going to be a decision that the developer would be making based on what's going to be appropriate within that particular community and be marketable. Keep in mind, as I mentioned, that mixed income is possible, and in that way we're going to use our cost allocation process to make a designation of which of our units are going to be our home units and have those restrictions which might be unrestricted from the home funding. Mixed use is also possible. So we might have, let's say we had an existing hotel in a downtown that sat vacant, and we're going to redevelop that into senior housing. It might be that the ground floor of that building is going to be commercial office space, but the upper floors would be housing. The home funds would be restricted only to the residential portion of that structure. And so the proposal for that project would need to be very clear about how those funds were being used. In most cases, the budget or the funding agreement that you're going to receive is going to be very specific about how the home funds are being used, because ADFA, of course, needs to ensure that the home funds are used for eligible uses and not used for something that would be deemed ineligible. Home funds can be used for group homes, transitional housing, or single room occupancy, SROs. That's acceptable, but the key here is that we're looking for permanent housing. So tenants would have a lease in their name, they have to be low income, and housing can't be conditional on participating in some kind of service program. So we might have, let's say we're doing a permanent supportive housing project. Maybe our target audience are formerly homeless individuals. It's fine to have services provided. It makes sense based on our population that's going to occupy the building. We want to have appropriate services available, but we can't make that a condition of being allowed to occupy that unit. That would put it more into a category of some kind of a treatment center or a facility. So home will say it cannot be conditioned as part of occupancy, so we would look to the leases to make sure that was not in place. Over the years, there has been some back and forth about can home funds be combined with Hope 6, which is a public housing source. It has currently been deemed as okay. We will talk later that our 1937 Act public housing is something that's not eligible for combination with home, but Hope 6 is not under the 1937 Act, and so is something that is eligible. So things that we cannot use our home funds for would be something deemed as a facility, and that's where we're talking about this restriction of terms and conditions of occupying those units is participating in some kind of service as a condition of occupancy. Also things like halfway houses, farm worker dormitories, student housing is specifically called out and prohibited as part of the home requirements. As I mentioned, public housing units that are under the 1937 Act are also not eligible. One thing I want to point out here, in Arkansas, ADFA requires that all developers and contracts include a valid Arkansas contractor's license. So if you were not eligible, if you did not have that contractor's license, that project would not be eligible for home funding from ADFA. Let's talk a little bit about the forms of assistance. HUD allows a sort of a broader range of grants, loans, other forms of assistance, and also sort of the timing on this can be a little different. The home funds could be used as pre-development loans or grants. Oftentimes they are used for construction loans. Construction loans are deemed to be higher risk, so they tend to have a higher interest rate. Permanent mortgage loans, for those of you that might not be familiar with some of these banking terms, this is the permanent financing that's in place once construction has been completed. So normally the project would have a construction loan in place. Once that had been completed, they would be able to close on the permanent financing. They would pay off the construction loan. And then a bridge loan is when we essentially have to bridge a gap in timing on when funding is available. So for instance, we might have a project that included low-income housing tax credits that were going to be paid in to the project at specific points, and so not be available prior to that. And so a bridge loan would be a loan to provide financing temporarily to cover those costs until those other sources became available. And then credit enhancements would also be something under the HUD requirements that would be available. ADFA has specified that their loans will be limited to either construction loans, so this is covering our construction costs until construction is completed and the project closes on their permanent loans, and so that home construction loan would be paid off by another permanent loan. This is still a home-funded project, and so even though you pay off that construction loan, that project would still have long-term affordability requirements and all of the other requirements that go with the use of the federal funds. ADFA funds can also be used for the permanent financing. So this would also could be used to cover the construction loans, bridge loans, or other pre-development loans as part of that. Keep in mind, as I mentioned, that the ADFA home loans, the use of those funds is going to be restricted to home eligible costs. So generally you're going to have a written agreement that will have a line item budget that will specify the uses within that project so that ADFA can be very clear that their use of home funds fit with the allowable uses and that they're not allowing you to use it on some ineligible use. If there's an alternative, a creative, innovative form of financing, you would need to take that to ADFA. They would review that on a case-by-case basis and make a determination of whether that was a form of assistance that was going to work within their program. Some underwriting standards as part of this. So there's a minimum debt coverage ratio of 1 to 15. That includes the debt coverage service on the home loans. All of the loans are going to be have a fully executed promissory note, and they'll either be at 1% interest rate and then have a term or amortization period of 20 years, or they could be at 1% interest rate and then amortized that will match a longer affordability period. Also note that if the home funds are being used in combination with the USDA rural development or some other form of HUD financing, then those terms are going to match whatever is in place for those other funding sources within the project. The payments for the ADFA loans are going to be made on a monthly basis. They will be paid and due payment to ADFA. There is a standard of deferring the first year of payment from the time that that project is placed in service, and the timing on that is going to be based on when that project receives its permanent certificate of occupancy. Essentially, when a project is first completed and they start the rent-up project, generally it's going to take a period of time to be fully rented up and generating enough cash flow to be able to cover all the financial obligations. So there's a standard in place that there'll be a 1-year deferral on the ADFA loan portion of that. ADFA does have the ability to choose to defer up to 2 years, and that would be depending on the project needs. So looking at development, the number of units, and what that projected cash flow might be, and a need to defer that for 1 additional year. Let's talk a little bit about eligible costs. Very similar to what we talked about in our other modules. The home rules allow for home to be used for acquisition of land and structures, but keep in mind that home is a housing production program. So the home program requires that if you're purchasing vacant land, that construction must begin within 12 months. So it doesn't allow you to use home funds, purchase land, and then sort of figure out later how you're going to use this. ADFA would be reviewing your project, be looking at your production timeline, and making sure that your project was going to be in compliance with this 12-month construction start. Also, one of the restrictions on home funds is that our infrastructure, which would include sidewalks, roads, utilities, any of our water lines, sewer lines, those sorts of things, that is all eligible for on the project site. It also could extend into the public right-of-way to hook into the water line or tap into the sewer line, but the home funds cannot be used to cover any of those off-site costs. So, for instance, if you needed, let's say, a 10-inch water line to have adequate fire suppression, and where your new water lines at your project site tapped into the public infrastructure, maybe that line is undersized and there's a need to replace the water line in the public right-of-way for a couple of blocks to get back to that main line and be able to have a larger line. The line that you're putting on your project site would be eligible, but that line replacement in the public right-of-way cannot be covered using your home funds. Demolition, again, is something that's eligible under the home program, but because we are a housing production program, construction would need to begin within 12 months. And again, ADFA will be reviewing your proposed project timeline to make sure that you're going to be in compliance with that. All of your construction labor and your materials, of course, are included under eligible hard costs. For soft costs, all of your professional fees, architectural engineering, might include the cost of the environmental review, also might have costs related to legal and zoning on this. There is the eligibility under the HOME program to include what we call an initial operating deficit reserve. So this allows the project to project what that financial shortfall might be during that rent-up period for the project. So in this case, the HOME maximum on this is 18 months, and this is essentially to provide funding to cover any shortfall on operating expenses, debt service that needs to be made, other payments that need to be made to reserves during that time period. Now, since ADFA is deferring the first year payment on their loans, that would need to be taken into account as part of making this calculation. And so on a case-by-case basis, the project would have to demonstrate what that projected cash flow shortfall would be, and they could include as a project cost this initial operating deficit reserve. This is the only reserve that up front as part of a project cost can be included in the project. If those funds are not utilized during that initial rent-up period of up to 18 months, it's the discretion of ADFA to determine whether that can be retained as part of the project reserves or not. Let's talk a little bit about developer fee. So the developer fee is going to be restricted based on the NOFA limitation, so that would be set on an annual basis. Some restrictions on how that is sized and also how it's paid out. So the funds are going to be on a pro rata share for the developer fee. So if the HOME funds are 30% of the overall project costs, then the maximum that HOME funds are going to be utilized to cover that developer fee is going to be based on that percentage. Also, the availability on this, 50% of that developer fee and only the pro rata share of that can be paid at the point that the project is 50% complete. The balance of that developer fee will not be made available, not paid out, until after approval of all the project-related retainage documents. So once the project has been completed, all the inspections have been done, and after the retainage period has been completed, only then will that second half of the developer fee be paid out. One note on this, developers can't try to do an end run around this restriction by hiring themselves as part of the project as a consultant on their home-funded project and then essentially be not only receiving a developer fee, but also directly being paid as a consultant. That is not allowable within the ADFA HOME program. Eligible relocation costs. So generally, ADFA is going to discourage you in undertaking a project that's going to result in the displacement of individuals or commercial operations. And as part of their application review, they'll be looking at any potential relocation issues that would be part of that project. If you're looking at a potential project that would include displacement, I would recommend that you contact ADFA, talk through the details of that displacement, and determine whether that's going to be a viable project. If there's a project that included relocation, then that's going to trigger the Uniform Relocation Act. We'll talk a little bit about that under our other federal requirement section, but essentially it requires that relocation payments be made to make sure that where they are being displaced to, that new unit is going to be affordable for them. It covers moving expenses. There are advisory services that are provided to each of those displaced tenants, and temporary relocation may also be provided where we need to temporarily move someone on the project site or temporarily move them off the project site and then allow them to return. So all of that is part of a planning process. The staffing, the costs would need to be identified and would be part of your application. It's important to understand that this covers all households in the home project, not just low-income individuals. Let's also talk a little bit about eligible costs for running a program and administering a project. So for a subrecipient, a state recipient, the HUD program allows these costs to be incurred and charged off as either an administrative cost, which we know from our home requirements is a maximum of 10%, which is shared between ADFA and all of its subrecipients and state recipients. Some of the costs can also be charged off as a project-related soft cost. So ADFA has imposed a restriction in place that is going to essentially cap the combination of those project-related soft costs and anything identified as admin. So they will be tracking those costs and making sure that they do not exceed the 10% cap for that project or program. For project-related soft costs, so to be charged off to that specific project, there has to be an adequate paper trail to be able to document that those costs are directly related with those home units. In some cases, that may be prorated amongst the assisted units. So we might have a project where we have, let's say, architectural or engineering costs. That could be prorated across our home units and charged off as a project-related soft cost. Those costs will need to be documented through a certification of costs. There is a standard form that's been provided by ADFA. It's available at the web link that's listed here on the slide. And keep in mind that the cost certification must be performed by a CPA. Ineligible costs. So we mentioned that the only reserve that can be included as part of a project cost would be this initial 18-month operating reserve for the rent-up period. Other reserves, such as an operating reserve or a replacement reserve, those are going to be capitalized over time by payments that are made into reserve accounts coming from cash flow or other sources. So the only type of reserve that could be capitalized as part of a project cost would be this 18-month operating reserve. We also mentioned about development operations or modernization of public housing. That's the 1937 Act that is blocked from combination with home funds. You also cannot charge fees for servicing, origination fees for loans that you might be doing, or other fees that essentially you're trying to collect revenue to cover the costs of administering the home program. Those costs are to be covered either through admin funds that you're receiving, project-related costs that are billed directly to the project, or might be covered under a developer fee for that developer. They cannot be charged through a series of fees to the beneficiaries. It's also ineligible for home funds to be used to purchase PJ-owned properties. We'll talk later in the later module about tenant-based rental assistance, which is a tenant-specific rental assistance to help make units more affordable. HUD does provide in other funding sources project-based rental assistance, but this is not an eligible use of home funds. You could have a home-funded project that received another HUD source of project-based rental assistance. That would be fine. You simply can't use your home funds to set up a rental assistance for that home-funded property. Delinquent taxes, fees, other charges are, again, not going to be eligible under the home program. And then any of the items that are identified under 2 CFR Part 200, which are the federal financial circulars. Some of you may be familiar with this as A87. That's the old terminology. They now have all been combined under 2 CFR Part 200. Any of those items that are called out as being ineligible would be ineligible for the home program. And keep in mind that all costs will have to be deemed as cost reasonable. So part of ADFA's review of a funding proposal would be evaluating, are the costs that are included here in your request for funding, are they all cost reasonable? There are cost limitations in place that are imposed by HUD. They've put in place a maximum and a minimum subsidy limit. Those are updated on an annual basis, and as part of ADFA's review of your proposal, they will be making sure that your proposed project is within those maximum limits, which change over time. The minimum limit is that you have to have at least $1,000 average per unit investment. Probably not a problem to find at least $1,000 in eligible costs. And then for actual assistance, it's going to be based on ADFA performing its cost allocation process, subsidy layering, and underwriting. So analyzing what are all the other sources, what are the uses for this project, making sure that the home investment is proportional to that return of a long-term affordable units. And so ADFA is going to be completing that process at the point that they are funding your application. That's going to be based on the information that you've submitted as part of your application. So if there are any changes to that project, not only at the front of this as you're proposing funding, but also throughout the period of affordability, if there are changes to the number of units or development costs, financing sources, those things, you would need to notify ADFA because they may need to go back and re-underwrite or re-evaluate to make sure that the project will still be in compliance with those HUD requirements. As part of the cost allocation process and underwriting, ADFA will determine the number of home units that will be required within the project, and that will be designated within your home written agreement. Those will be, in many cases, spelled out specifically based on unit size. So it would generally be proportional. So if we have some 1, 2, and 3 bedroom units, the designated home units will include each of those types or sizes of units. The question then becomes, well, how do we decide which units, when we go to rent up and over the life of the project, how do we decide which of these actual units are going to be the designated units, have the rent restrictions, income, all of that? So HUD allows some flexibility through a concept of designating these units as either fixed or floating. So if we designated our units as fixed, we would pick specific units that would always be our home units, always have a home income eligible tenant, paying at maximum a home rent. Home allows a little more flexibility with a concept of floating. So we could say, okay, if your project's going to have 10 3-bedroom home-assisted units, that they could float amongst those comparable 3-bedroom units. So at any given point within that project's affordability period, the 10 units, the 3-bedroom units, might be a different mix as incomes change and tenants move in and out of the project. ADFA will make that designation as part of their review and designate it as part of the commitment. So your written agreement will specify whether this is going to be a fixed or a floating project, and so you need to be aware of that and follow what's been designated within your unit. This is just a visual to try to help you think through this. So we might, if we were going to designate 2 of these units, we might say, okay, all right, my home-assisted unit is going to be 2A and 3B, and that would be our fixed units. If we were going to do floating, we would say, okay, 2 of my comparable units are going to be home-assisted units at any point during that project. So it might be at initial occupancy that 2A and 3A are actually our home-eligible units, but it might be that later in the project, it's actually 2B and 3A are actually our home units. And we'll talk more about changes in unit designation as we talk about income changes for tenants over the life of that project. We'll go into much more detail on that. So the key to our floating units is that they must be comparable units. Generally, we're going to consider the same number of bedrooms to be a comparable unit. Where we might need to be a little more specific on that would be if there were some significant differences in either the amenities that were provided in those similar number of bedroom units, or whether they were, the square footage might be significantly different. You might have a project where you had townhouse units and flats, and maybe the townhouse units had a lower level, so made them quite a bit larger. And so we might be breaking our townhouse units out as floating amongst themselves, whereas the flats would be comparable to each other. So it's generally going to be based on number of bedrooms, unless there are some other significant differences. So we'll have property standards, and we'll talk about these in terms of the type of project that you're undertaking. So if you were acquiring, if this was an acquisition-only project, then at the time that you're committing funds to this project, that project's going to have to meet all of your housing quality standards. Can't include any of the deficiencies that would be included within the UPCS standards, which is the HUD-based standard. ADFA would have specified what those would be. Keep in mind that that inspection needs to be current, and that's really defined as it can be no older than 90 days before the home funds are committed. We want to know that it's a good representation of what the current condition of those units would be, and they have to meet standards at the time of occupancy because, of course, this is not paired as an acquisition only. It's not paired with any kind of rehabilitation. So they must meet our standards at the point that we're acquiring them and we're going to allow folks to occupy. If we're combining our acquisition with rehabilitation, then all of our rehab projects are going to also have to meet ADFA's written standards and the state and local codes. So in cases where there's no state and local code that exists, or particularly for existing housing, we would refer to the existing building code for the International Code Council and also the Energy Conservation Code. When those units have been completed, they have to be free of all the deficiencies that would be included in the UPCS, the Uniform Physical Condition Standards. But keep in mind that health and safety items would have to be addressed before you could allow that unit to be occupied. So ADFA's written rehabilitation standards defines what would be considered a health and safety violation. Those would have to be addressed before the unit could be occupied. Once those have been addressed, the unit could be occupied. The rest of the rehabilitation would need to be completed before that project was considered to be complete. For acquisition and rehab, there has to be an inspection prior to occupancy. As we mentioned, those health and safety items have to be dealt with before occupancy, and then the balance of any rehab that needs to be done must be done within a 6-month period. At the end of that project, all of the applicable codes will have been met, and an inspection will be done to verify that those units are in standards. HUD requires each PJ participating jurisdiction, which ADFA is, to adopt written rehabilitation standards. And so as part of this, their standards define what do they consider to be a health and safety hazard, what's the minimum useful life for all of their major systems. HUD has said it's a minimum of 5 years. It could be set longer. Also identifying any life-threatening deficiencies that need to be addressed before any of those units can be occupied. If you have a pre-1978 unit, that's going to fall under the lead regulations, and so that will be a part of the property standards. Also keep in mind accessibility standards such as 504 might apply to your project, and also the ADFA written rehabilitation standards identify any disaster mitigation requirements that would be in place for assisted properties. So under ADFA's specific requirements for property standards, if you look to the ADFA Construction Performance Manual, sections 1 and 2 will apply as part of this. Also, ADFA has selected universal design as part of their accessibility requirements that would apply for acquisition rehab projects. There are also multifamily housing design standards, the Arkansas Energy Code, International Code Council codes, and then that overlay of any state or local property codes, along with zoning, as I mentioned, the disaster mitigation, and then any handicap accessibility requirements. So as part of that, they're going to be reviewing your project, making sure that it's meeting these requirements. So in a rehabilitation proposal, you would have an inspection of that project and have identified what that scope of work was that was needed to bring that property up to the applicable standards. HUD also has set separately property standards for new construction. So again, state or local code. In the case where there are no state and local code, then it's the International Code Council's residential code or their building code, but it also includes the International Energy Conservation Code. I want to point out the site and neighborhood standards. This is the one place that you will see this reference. So HUD has in place a requirement that when it is new construction of rental housing, that ADFA is required to have a site and neighborhood standard in place and to have a process to review that. So essentially, at the point you have a choice of where am I going to place my investment and create new affordable housing, there need to be standards about that site and the impact of that surrounding neighborhood, access to jobs, public services, transportation, those sorts of things. So that would be part of ADFA's review of a proposed new construction rental property. And then, of course, fair housing standards are also going to apply. So as we mentioned, for our rehabilitation projects, the standard for new construction includes the ADFA Construction Performance Manual and all of the other requirements, or many of the other requirements that apply to rehabilitation. Also keep in mind, specific to ADFA for new construction, there is Arkansas Usability Standards, which is essentially an accessibility requirement. And then also, as we mentioned in an earlier section, are required to provide a survey and a proposed site plan for that property. Also, evidence of the soil type for that proposed project site, and then evidence that the foundation that's being proposed is suitable based on the soil type that's been identified. And again, permanent utility hookups, permanent foundations are something that is required for all of the home-funded projects. Let's talk a little bit about useful life in our rental projects. The PJ is required to estimate the remaining useful life of all of the major systems and make sure that they are going to be in compliance with their minimum useful life standard that would be set as part of their written rehabilitation standards. For projects that have 26 or more total units, this is for rehab only, there's a requirement that a capital needs assessment be completed. Essentially what this is doing is looking at each component, each system or component for that property and projecting during that affordability period. So for rehab, we're going to have 5, 10, or 15 years, looking at all of those systems and components and estimating the reserve, the replacement reserve that would be needed. What are those expenses that are going to be experienced by that project during the affordability period? So if we have, let's say we have existing water heaters that have another 10-year lifespan, and we have a 15-year affordability period. So we know that we're going to have expenses related to replacing those water heaters. Same thing with the boiler system, a roof, whatever that would be. So the capital needs assessment is essentially calculating how much cash is going to be needed for that project during that affordability period, and then comparing it to the projected reserves that will be available. If those reserves are not going to be adequate to cover those projected expenses, then ADFA would either need to work with the developer to change the scope of work so that some of those systems that would later need replacement might be replaced up front as part of a capital cost that's included in your project, or to raise the level of reserves that were going to be paid in, and of course underwriting that project to know that it was going to be possible out of cash flow for that project to build a higher level of reserve in place. So that's required for projects with 26 or more units, but all projects need to, as part of their rehabilitation specs, look at the required useful life and make a determination on whether those components will actually have that useful life remaining or whether they need to be replaced as part of that project. Mentioned in the program-wide requirements that the home program now requires that all rental units have to be occupied at initial occupancy within 18 months of that project completion. If they fail to be occupied within that time period, those funds are then ineligible and would have to be repaid. So for any units that are not leased within 6 months, ADFA is being required to report back to HUD on what the current marketing efforts are, what's the plan to make sure that these units are going to be leased within that 18-month time period. So ADFA is going to be looking to that project to report in a timely manner on the progress that's being made on renting up those units. So hopefully within that 6-month period, they will be able to report to HUD that they're all rented up. If not, ADFA will be asking you for additional information because HUD's going to be coming to them asking additional questions. If you were to fail to meet that initial occupancy for those home-assisted units by that 18-month limit, ADFA will be requiring that you repay those home funds that were invested in that unit. So let's say you had 10 home-assisted units, 8 of them were rented up during that time period, but 2 never actually achieved initial occupancy. ADFA would be calculating what the home subsidy was that went into those 2 unoccupied units, and that would be required to be repaid, and that would go back essentially into their line of credit with HUD. So let's talk about long-term affordability requirements. As I mentioned, it's going to be based on that average per unit investment, and so Home has specified that under $15,000, it's a minimum of a 5-year affordability period. For units that have an investment of $15,000 to $40,000 per unit, 10 years, and then anything over $40,000 is going to be an automatic 15 years. That's for rehabilitation. Any new construction rental project will have an automatic 20-year affordability period. ADFA does not allow for refinancing as part of a rehab project, and so this 15-year category that HUD has mandated is not applicable. So for rehab, your time period, affordability period is going to be 5, 10, or 15 years, and for all new construction, it's going to be a 20-year affordability period. The home rules require that if that project does not remain compliant for that full affordability period, that the home investment needs to be repaid. And that is not, when we talked about home buyer, those allow a proration, so essentially there's some credit for the years that it provided affordable housing. If we had a rental project with a 20-year affordability period, and for 18 years that project was sustainable, was providing affordable housing, but in year 18 then those units stopped being occupied as affordable units, that project would be considered non-compliant because it didn't finish the affordability period, and all of the funding that was provided, all the home funding would be payable back to HUD. ADFA would be required to return those funds to HUD. They will be turning and enforcing their written agreement requiring you to repay those funds, which is why it's so very important to for projects to be carefully underwritten, very carefully managed to make sure that they're going to be sustainable and in compliance for that affordability period. Graphic is simply showing you an example of, depending on the number of home units that you designate, will have an impact on the affordability period. So we mentioned that at a minimum, it's going to be based on the investment per unit. If we designate, in this project, we have $240,000 invested. We are dividing this into, or designating 5 units in the project as being home assisted. We would have a 15-year affordability period. If we chose to designate additional units, so if we chose to designate 8 units instead of the 5, we would now only have a 10-year affordability period on the overall project, but of course we would have more units that would have home restrictions that apply to them. So depending on the designation on the number of units can have an impact on what that affordability period would be and what units will fall under that compliance requirements during the affordability period. So during that affordability period, we're going to have rent and occupancy requirements that will be in place. These need to be legally enforceable, and so each of the projects will be required to have a deed restriction in place that will allow that enforcement. In the case where a project went through a foreclosure process and that deed restriction was stripped away by the courts, any unpaid balance from that project would have to be repaid by HUD. So they would be trying to enforce their written agreement and collect that balance. Once that deed restriction is stripped away, there's not an enforceable affordability period, and so it would lose its designation and trigger repayment of funds. Let's talk about the rent limit. So the way we're going to establish that our units remain affordable is by setting affordable rents. So the home program itself designates high and low home rents. These are calculated and published by HUD. They are not something that ADFA or you as a developer would have to make that calculation. These are provided on an annual basis. Once ADFA is notified of the new levels, they would be notifying each developer, each owner of the new limits. And of course, each one of these will have a specific date on them on when they go into force. So usually you're getting them, several weeks to a month in advance. So as you are recertifying leases, you would be notifying tenants about those increases based on the new rent limits on that. Now, HUD allows that those unit rents could be less than these limits, but it does set a cap on that based on high and low units. So under the home program, rents are not normally a percentage of an individual household income. They are set specifically for each unit. So you might have 3-bedroom units that will have a set rent of, I don't know, $700, and you might have some that had a low home rent that maybe would be set at $750. So it's not going to be based on each individual household income. So you will not be calculating and determining that, you know, one household occupying this unit is going to pay a different amount than the other. It's based, the affordability is based on the unit, not on that individual income level. Now, we said that project-based subsidies cannot be funded by the home program, but there may be the ability for a project to get other sources of project-based subsidy. And essentially, if you're going to combine any project-based assistance with your home program, it needs to be in combination with those low home units. So the low home units will be occupied by a household at 50% and below, and they, to combine it with project-based assistance, they would have to be paying no more than 30% of their household income. In those cases, when you're combining that with a project-based assistance, you may be able to exceed the home limit and go up to what that contract limit would be for the subsidy program, because essentially the home tenant is only still paying 30% of their income. So that increase over the home rent is not really having an affordability impact on the individual household. Keep in mind that the home rents include any tenant-paid utilities. So if we have an $800 high home rent, and the tenant is paying $100 in utilities, that means that their maximum lease rent would be $100. We have to back out, or I'm sorry, would be $700. We have to back out the utilities to determine what that actual lease rent would be. So we make that an adjustment for each of our rent levels. So as part of that, we're going to use either the HUD utility model or the actual utility costs that have been tracked for those units to make that determination of what amount of, what are we projecting as the tenant-paid utilities that will need to be subtracted out of that home rent to determine the maximum rent that we can charge that tenant. ADFA has specified that if we have a project that included food and other services as part of that, those need to be broken out so that we can actually show what is the actual rent that's being paid versus costs that are related to the food or services that might be provided there. And as we mentioned, the participation in food or other services cannot be a term of occupancy as part of that. All right, so the high home rents, as I mentioned, they're going to be published by the home program, and they're essentially based upon what 30% of a projected 65% median income for that area would be. They're also comparing that to fair market rents, and they're going to take the lower of the two. A little bit different of a calculation than for the low home rents. They're based on either 30% of a 50% income, but they also could be based on 50% median capped at 30% of adjusted income. And so there's a little bit different of a calculation on how HUD is producing those. You don't really need to be worried about that. It will be provided to you. If that low home rent, because they're using a slightly different calculation methodology, is actually higher than the high home rent, they will cap it at that high home rent level. So if you were to see a chart of high and low home rents and fair market rents for your local community, in some places you're going to see that the high home rent and the low home rent are exactly the same. It's because the calculation is a little bit different. So what you would see from HUD and what ADFA would be providing you would be showing you, based on each bedroom size, they would give you a specific number, a rent level for that high or low home unit, and then keep in mind that that will have to be adjusted based on what the projected tenant paid utilities are. So in this case, we have a 3-bedroom unit. with $120 utility allowance. So to calculate out what the actual rent would be for the tenant, we would take, if we were looking at a high home unit, that's $740, backing out the $120 in utility allowances to be able to set the rent, or in the case of a low home unit, we would be utilizing the $710 minus the $120 for our utility allowance. Here's where things get a little tricky, and we're going to be kind of talking about changes over time. So over the life of that project, the rents are going to go up or down. Home rents are set based on income in the area. So if the economy is very strong for a period of time, rents might be higher. But if there were problems with the economy, we might see overall incomes going down in the area, and so we would see the home rents also go down. So the home program has put in place that an owner is not required to accept a lower rent level than what was put in place at the initial agreement. So essentially, if ADFA underwrote a project and the initial rents were going to be $600 for a two-bedroom unit, if a number of years later those home rents are actually down at $550, ADFA cannot require that property owner to reduce the rents below that initial $600 level. Now, keep in mind, if the market rents in that area have actually overall gone down, you may have difficulty being able to rent that unit at $600 now when the rest of the market is actually reflecting lower costs. ADFA will be providing you with those new rent schedules as they're made available from HUD. So you as an owner that were notified of those new rent schedules, you would need to make sure that those were distributed to each of your property managers so they know what the correct requirements would be at the point that they are, renting units. So let's talk about a couple of rules that apply to our projects. We have both a project rule and a program rule. So the project rule states that if we have 5 or more home-assisted units for that project, that at least 20% of those units are going to have to be set aside for families at 50% or below. So on our larger projects, 5 or more home-assisted units, we're going to set aside some additional units to be more affordable. At the funding, ADFA would be making that designation that would be called out within your funding agreement. So those units, when we rent them, will have to be occupied by households at 50% and below. They're going to be capped on their rent by the low home rent instead of the high home rent. The balance of the units in the project under the home rules will be allowed to be at that, go up to 80% income levels and charge a high home rent. So this is, again, where if we have floating units, my low home units over the life of the project might be different units within my project, but I will always have that designated number to stay in compliance with my agreement. Keep in mind that eligibility for occupancy is going to be based on gross income, not adjusted income. We also have a program rule. So this applies overall for ADFA as they're administering their programs, and requires that at least 90% of all the households at initial occupancy, and that's for both rental and tenant-based rental assistance, have to have incomes at or below 60%. And so essentially trying to make sure that the first shot on getting into newly made available affordable units is going to be targeted a little bit lower. It's not project specific. It is only at initial occupancy, and so allows that restriction to fall away after the initial occupancy has been completed for those projects. So let's talk a little bit about income eligibility. We are always going to be certifying that each new tenant is going to be eligible. So at move-in, we're going to do an income certification and make sure they are eligible to participate in the program to occupy a unit. Home itself allows for either the Part 5, Section 8 or the IRS definition of income. ADFA has selected that it's always going to use the Part 5, Section 8. And that makes sense because the low-income housing tax credit program only uses the Part 5, Section 8. So full source documentation is going to be utilized to verify eligibility at the point that a tenant moves in to that unit. The tenant income is also going to be re-examined every year. So home itself gives a little bit more flexibility in those other years. So at initial occupancy, we're always doing full source documentation, and that can be the policy that you utilize for all of the subsequent years. ADFA has the discretion to allow a project to use a self-certification from the family the rest of the years. It also has the discretion to allow a project to use verification that some other government-funded program has found them to be income eligible, and by definition, if they're eligible for the other program, they would be eligible for the home program. Now, keep in mind, home has put in place a requirement that at initial occupancy, everybody must have source documentation. It also requires for every 6th year of the affordability period that source documentation will be used for everyone. So if my project is placed in service in 2018, so everyone moving in at initial occupancy, whether it's in 2018, 19, 2021, at initial occupancy, we're always going to do source documentation. But that 6th year of affordability, the 12th year, the 18th year, because we have a 20-year affordability period for new construction, we're going to need to do full source documentation on all tenants, even if ADFA has allowed us to do one of these other more flexible forms for those non-initial occupancy. Keep in mind that the property manager, the owner, is responsible for completing those income recertifications. It will be part of then designating what the appropriate rent and utilities are being charged, renewing those leases. That will be part of the process that each project will also be reporting back to ADFA based on their rent and occupancy information. So the ADFA staff and overseeing the home funds will be reviewing the process that the management staff is utilizing. Generally, that's going to probably happen every 2 to 3 years, and so those records need to be in place. Local property managers need to be provided appropriate training so that they will be able to implement this in compliance. And their sort of go-to document will be that written agreement, which will spell out which of these units are home-assisted units, what are the maximum rents, are they fixed, are they floating, so that they know when they have a unit that's available, who's eligible to live here, what are the rents and utility structure that would apply to that particular unit. So here's where we're going to talk a little bit about these changes over time. So when we do the annual recertification, as we see incomes change over time, there may be actions that we need to take. So let's start on the left side of this chart. So if we recertify a unit and we find that their income is now over 80%, we said that all home units have to be occupied by households at 80% or below. So when we recertify their income and we find that it's gone over that, depending on whether it's a fixed unit or a floating unit, we will take different actions. For a fixed unit, we're going to raise that rent to 30% of their monthly income. So depending on what's happening in that local market, that might be a pretty significant rent increase. We're not going to require that tenant to move out, but we are going to raise their rent. At that point, they may look around in the market and say, you know, if I'm paying this amount of money, I have other choices. We may see that tenant move, but they also may choose to simply stay there. When the next unit becomes available, we are going to make sure that it is rented based on our proportional requirements of high and low units. And keep in mind, with fixed units, we have specific units that are going to be our home units. No additional action is going to be taken on on those units. We can't require someone to move out. We can't, with a fixed project, we can't say, well, let's just switch this out. Let's call a different unit in our project the home unit. We're going to keep these same units and simply monitor this until the point that tenant moves out, and we will then re-rent that unit for another income-eligible household. This is what would be called temporary non-compliance, and what ADFA would be looking for would be that you understand that we have an over-income tenant, you've made the appropriate raise in income, and that when you have the next opportunity to get this unit back into compliance, that you'll rent it to another income-eligible household and have them pay the appropriate rent level. Rules are a little different if that's a floating unit. So we're actually going to be slightly less aggressive. So we're going to raise their rent to either 30% of what their monthly income is, or a maximum of what comparable market rents might be. So maybe 30% of their monthly income would put the rent at $900 a month, but there are comparable market rate units in that same market that are at $800, then we would cap that rent at that comparable market rent. Because this is a floating unit then, we are going to, at our next option, we're going to designate one of our non-home units as our new home unit. So we're essentially going to replace this unit that's out of compliance with another unit within our project. And with that designation, make sure that the new unit is either high or low based on what is needed. Once that replacement has occurred, then this unit that's out of compliance becomes one of our non-home units, and so it's sort of outside of those requirements. In some cases, when we verify their income, we're going to find that their income has gone over 50%, so they were one of our low home units, but they're still below 80%. So our actions are going to be a little bit different. So we're going to keep their rent and their designation as a low home unit until we're able to redesignate another unit within that project as a low home rent. So for instance, if I have a project that my written agreement says that I'm going to have 10 home units and I have, let's say, 3 of those as low home units, I might, as part of my rent roll, I might realize that I actually have a household occupying one of my high home units that actually has an income below 50%, at or below 50%. I could redesignate that household when their lease comes up for renewal. I could redesignate them as a low home unit, charge them the low home rent, and then be able to go back to this non-compliant unit and redesignate them as a high home unit for this household that's over the 50% income level. Once I've redesignated, replaced the low home unit, I'm able to make that redesignation. So many times we're able to actually make those corrections or switches based on the current tenants that are occupying that structure. If not, we're going to wait till our next unit becomes available, and we're going to rent that unit appropriately so that we can bring that property back into compliance. So this just takes you in a little bit more detail. If we have a tenant in a low home unit that their income goes over 50%, but remains below the 80%, then we're going to work at redesignating. We're going to work at finding another low home unit and be able to change that designation. Once we've replaced that unit with another low home unit, we can go back to this over income tenant and redesignate their unit as a high home unit and raise their rent to that high home level. And again, this is all going to happen at the point that we're renewing leases. So if I have a 1-year lease, I can't, change this during that lease term. I'm going to be waiting until that happens. I will point out that the low-income housing tax credit program has a different definition of when a household is over income. And so when we have a home unit that also is designated as a tax credit unit, we will defer to the low-income housing tax credit program. So they would not take action when the household goes over 80%, and we would wait till the low-income housing tax credit rule kicks in, essentially. If we have a tenant that goes over income that's in a fixed unit, as we mentioned, if it goes over 80%, they can remain in that unit, but we're going to raise their rent to 30% of their monthly income. And then when we have the next available home assisted unit, we're going to make sure that we rent it to an income eligible household. If we need another low income or very low income to be a low home unit, we would rent that accordingly. I will mention that there are 2 HUD guides that have been created, rental compliance guides. Those are available on the HUD Exchange. One is written from the perspective for the PJ, who is overseeing programs, and one is written for the property owner to utilize. And I would recommend that you look those up. I think ADFA could also provide you with that linkage. Here we have the example of the floating unit that we mentioned, that in the case of the floating unit, we're going to raise that rent level for the household that's gone over 80% to either the lower of comparable market rents or 30% of their adjusted income. And again, we're going to take the next available action that we can to replace that unit, redesignate units on this. So let's talk a little bit about monitoring inspection. So the PJ, so ADFA, is required to verify compliance with the home requirements every year. That does not mean that they have to be on site every year, but they're going to be reviewing records and submissions that are going to be coming from you. So rent and occupancy information, draw requests, your schedule of rents and utilities are things they're going to be inspecting. They are required under the home requirements to come on site and complete property inspections, and that schedule has been changed a little bit with the new home rule. So ADFA is required at project completion to have an inspection completed within 1 year after project completion. If that inspection goes acceptably well, they can then go to an every 3-year schedule on that. If there are issues that are identified in that 1-year inspection, then ADFA would probably be placing you on a more frequent inspection schedule until they were confident that whatever those issues were had been resolved. If the 1-year inspection observes deficiencies, they may have, a protocol of follow-up site inspections. They would be requiring that if there are any life-threatening health and safety deficiencies, that they would have to be completed immediately on that. ADFA would also establish non-hazardous deficiencies that were observed that would need to be corrected, and then would allow for a third party to come in, make those inspections, and verify that these actions have been completed. And that might be verified through an invoice to show that that work had been completed. They are responsible to make sure that you are following the property standards. They're making sure that our tenants are in not only decent units, but also that they're paying the correct rent and utility requirements on that. So ADFA, when they do their on-site monitoring, if your project is 1 to 4 units, they're going to be inspecting all of the units. For projects with more than 4 units, ADFA will be determining what they consider to be a statistically valid sample. As part of that, they would be looking at, if you have multiple buildings, they'd be looking at least 1 unit in each of those buildings so that they have a good sample of what's happening on that project site. The owner of each of the home-funded properties is required to provide a certification to ADFA on an annual basis. And that certification is verifying that each building and all of the home-assisted units are meeting the occupancy requirements, so that they are being maintained in compliance with those project standards. ADFA will be reviewing those. They also will be reviewing rent and utility schedules and approving those. So there'll be an annual process where owners will be providing to ADFA their certification on building conditions and also their proposed rent and utility schedule. ADFA will review and approve, and then those would be able to be implemented. We mentioned that there are some lease terms that are prohibited under the home program. Home requires that leases be at least for 1 year. There are some cases where if both the owner and the tenant agree, they could be for different periods. Sometimes we see longer periods on that. Leases are not able to contain any of the prohibited clauses. If you look in the chapter, you will see the list of prohibited clauses, and they essentially are things where the tenant is being required to waive some of their rights. The home program requires that an owner needs to provide at least 30 days notice to terminate the occupancy of that unit, and owners are required to have a written tenant selection policy and criteria. So this is laying out in writing, how will I decide who has the right to occupy this unit when it becomes available. So that may outline how a waiting list is going to be determined, rights for existing tenants on that property who perhaps want to switch units, whether there are priorities of folks who will have a first right to the next available unit. All of that needs to be contained in a written tenant selection policy for each project. The program also requires ADFA to provide financial oversight. This is found in the regulations at 92504, section D2. ADFA is required to annually review the financial condition of rental projects, specifically that have 10 or more home units. So ADFA will be asking some questions concerning what's happening financially for those projects. That might include what balances were in reserves, what sort of occupancy levels were being maintained, any sort of maintenance issues or draws on those reserves. If problems are identified, they may require action on that. And that might require some additional reporting, some additional information about what is happening financially for that project. It may mean some more frequent monitoring. What they're trying to do is make sure that if projects begin to show early signs of what might be a financial instability of projects, that they want to intercede and try to take action, work with that project to make sure that that project can be stabilized. That might be in terms of some technical assistance, might be identifying some other funding that could be brought in to handle that situation. In some cases, it might be trying to switch ownership for that project. The home regulations do allow the potential for a reduction in home units. So in some cases where we have a project that's experiencing some financial instability, it might be by restructuring the rents, that by having some units that no longer are home and are able to charge a market rent might bring in some additional funding on that. So HUD would have to review any reduction in home units. It's going to be based on the language about troubled projects that's at 92.210. And it would be essentially something that you would work with ADFA. ADFA would then choose whether to take that forward to HUD and try to see that some change could be made. For projects that are 100% home assisted, Home has also stated that they may consider allowing one of those units to be converted to an on-site manager's unit, and this is essentially in a case where it's felt that by having an on-site manager, that would help to stabilize that project. This is only possible if HUD is able to determine that this project would still meet the cost allocation subsidy limits that are in place after they remove one of those home-assisted units. So again, this would be something that you would work with ADFA on determining what the appropriate approach would be, and it could be that ADFA would work with HUD to try to see if that project needed to be modified in some way. The home program does allow for some flexibility under troubled projects. And when we talk about troubled projects, that would be projects that have some significant shortfall in operating funds that are available. HUD would have to review and approve any potential changes to that project structure. That might include being allowed to add some additional home dollars to the project. All of this would have to be re-underwritten. It would have to be in compliance with whatever the current subsidy limits are for that project. And again, this is something that HUD headquarters would have to approve in conjunction with ADFA, not something that you can do on your own. So the forms that are related to a rental project, ADFA has provided a whole number of forms which help guide you, help make sure that you're collecting the needed information. There's a multifamily housing application where they're collecting the information needed about your project, including what they would need to be able to complete their underwriting, their cost allocation, and their subsidy layering analysis. There's an environmental assessment form. We'll be talking in the other federal section about the environmental review requirements. This would also include the environmental statutory checklist that will be completed as part of that. There is a multifamily minimum design standard checklist, which will help guide you to make sure that your project is going to be meeting those requirements. We mentioned earlier that our soft costs are going to be cost certified, and there is a standard form that would be used in conjunction with the CPA to be able to complete that process. In addition, there are standard home forms to use that will provide what the rent limits are, what income limits are for projects, utility allowances, help you through that determination. There is a home rental compliance report and annual certification form. So each of the properties will annually be completing that and submitting that to ADFA. That would also include the annual certification we mentioned about that the property continues to meet those minimum property standards. There are Section 3 reporting forms, so projects that have triggered Section 3 and need to report about either jobs or Section 3 vendors under their contracting, that form will be used for that. There is also a checklist for affirmative marketing, for the tenant selection requirements that we mentioned, and also we mentioned that lease provisions, there's a lease compliance checklist that's also provided. Also standard certifications for all of your trade selections, your plumbing, electric, HVAC certifications, and then also standard forms for release of liens and final inspections. All of those would need to be completed for each project and would be held in the project file, some of which also are submitted to ADFA.